Hey everyone, I'm Samuel Smith, and recently I asked my dividend investing channel subscribers in a poll if they wanted me to do more screenshot formatted videos where I do a deep dive into one of my highest conviction stocks and or ETFs of the moment, and thereby provide greater insights into how I analyze stocks, some of the tools that I use to analyze stocks, and ultimately give you more value. Now, I still plan to do my other videos, which are focusing on my face, and I'll be giving you my commentary on investing strategy, lessons learned, portfolio, even some macro insights. But for my individual stock and ETF analysis videos, I'm going to do more screenshot focus so that way I can show you how I dig into the tools and add more value to you. And so in today's video, I'm going to talk about why midstream infrastructure is now my favorite place to be investing, my highest conviction investment opportunity. After the past several years, it's been gold, and in particular gold bullion leases. I've put a lot of capital into those, but now it's midstream infrastructure. I'm going to share with you not only why I'm bullish on midstream infrastructure, but also one of my favorite places to buy midstream infrastructure today. And I'm going to show you from some of my favorite tools, in particular, one in particular, investingpro.com, that I use to analyze stocks, not only to analyze them, but even to find good ideas and get quick summaries of the bullish and bearish thesis on them. So please stick around to the end. You'll get a lot of value from this video. So first of all, why am I bullish on midstream infrastructure? Well, I think this chart here shows from ONEOK, which is a blue chip midstream infrastructure company, one of the big reasons why I like midstream infrastructure so much right now. And in particular, if you look at this chart here, you can see their EBITDA grows very stable through all sorts of cycles, even with significant gyrations in WTI prices. The oil price collapsed down here, which wrecked a lot of companies, but midstream infrastructure just continued to be stable. Same with the COVID-19 disruption, which caused the price to fall even more than you'd see on this chart. There was a really rapid collapse. EBITDA actually continued to grow. Now, it's grown more in recent years due to acquisitions, but even on an organic basis, it continues to grow. And that's a big reason why I like it. And that's really just because energy infrastructure companies, especially in the midstream space, tend to have the vast majority of their cash flows contracted and or regulated. So they're much more resistant to commodity price volatility and even economic volatility. So that's a big reason why I like them. Another reason why I like them a lot right now is evidenced right here in this chart right here, which shows that their leverage ratio has come down a lot in recent years. And this is for MPLX, which is another blue chip midstream infrastructure business, but this is pretty much universal across the space. Leverage ratios have come down, credit ratings have gone up. The sector has arguably stronger balance sheets than they've ever had before. They're also generating more free cash flow than ever before, which enables them to address debt maturities as they come up quite well without being heavily dependent on the capital markets. And so that combination of stable cash flows, recession resistant, commodity price volatility resistant cash flows, and increasingly strong balance sheets makes it a really good place to be invested during uncertain times. At the same time, I also really like that these businesses have attractive valuations today. The vast majority of them have dividend yields in the mid to high single digits. Some even are in the low double digits, and that's very attractive on a yield basis, especially given these businesses are also growing. So they give you an attractive total return profile. And not only that, but they're attractive on a relative basis too. If you look at this recent chart that shows the comparison between the S&P 500 and the midstream infrastructure space over recent months, you can see that S&P 500 has been soaring while midstream has actually been declining. And again, that just goes to show even more so what an attractive valuation opportunity this is right now. Now, with that being said, let's dig into one of my favorite places to invest in the midstream space using arguably my favorite investing tool, especially if you're going to count for AI powered. So ONEOK is one of my very highest conviction opportunities right now in the midstream space and indeed the entire infrastructure space. And I'm going to dig into why. Now, one of my favorite tools to use is Investing Pro. And right now it's especially attractive because they are offering a 55% discount due to Black Friday here in the month of November. And if you use my coupon code, which is available right there in the video description as well as in the top pinned comment, you can get an additional exclusive 15% off discount on top of that 55% off discount. So now is a great time, really the best time of year to lock in this discount to be able to take advantage of this tool. All right, so let's look into why ONEOK is so great. Well, so what I can do here on Investing Pros, I can just go into the watch list tabs and I can create this, which can just give me nice metrics to monitor any stock that I'm interested in. It shows the current price, how it's changing. I can set any kind of price target I want to help me remember when to buy it or when to sell it. They also have a bunch of valuation models, which I'll dig into in a minute, which give you a fair value estimate. So this is their fair value estimate with the upside potential at this price. You can see they think it's quite attractive. They summarize that as being undervalued. They also show where analyst price targets are at $89, so even more upside if you go with the analyst consensus price target versus Investing Pros fair value metric. But again, obviously undervalued there. They also give an overall health score for the business, so it's in good health, so it's not a high risk venture. They give you the dividend yield here. And then something else that I like a lot is that they give you the relative strength index. Now, I'm not a technician, so I don't do all the fancy chart work, but it's nice to see this score that shows me, again, what market sentiment is like. And here it shows this kind of a low score for RSI indicates that it is largely out of favor right now, which indicates that it's probably undervalued. Now, I'll dig more into this later as well. So really, if you want to find a company on Investing Pro to just get the quick overview, you can just type it up into here, and that's what I've done here, got me ONEOK. So you can see all the things about it. What particular things stick out here are useful to see. So it's raised its dividend for 3 consecutive years, and indeed, it's actually been quite stable with its dividend over the long term. You can see that here. If you go back, you can see its dividends have been very stable, 25 years or more of dividend stability. So they've either grown it or held it stable for 25 years plus. But they've grown it for the past 3 years and have signaled they plan to continue doing so. I also love it that they have the latest 10K, 10Q, and 8K right here, linked right to the SEC.gov website. I can just click those and dig deeper, as I often do, into stocks that I'm studying. So that's a nice handy feature as well. Then the RSI, once again, I mentioned earlier, the technicals indicate, again, that it is oversold territory. And you can even click on this, and it will pop up and show you here, not only that it's in oversold territory, but where it is relative to peers. And you can see, for example, Kinder Morgan, which is a fellow C corporation, 1099 issuing tax form C corporation midstream infrastructure company. It is much more out of favor than they are, or additional peers as well. In fact, the peer average is 44.75. So this just shows how out of favor OKE is, which again indicates that it can often be a bullish signal because it might mean the stock has been undervalued and investors consider it a potential buying opportunity. Here it also suggests that the stock's price has fallen sharply and could be due for a rebound. So that's an immediate hint to me that this could be an undervalued stock and that it's a particularly attractive time to buy it. Now, it does say 8 analysts have revised their earnings downward for the upcoming period, but again, that's a very short-term thing. OKE is an energy infrastructure company. The vast majority of its cash flows are contracted, but it does have about 10% of them that are commodity price sensitive. Energy prices have come down recently, so that is slightly hurting their near-term earnings performance. But again, energy prices are volatile, and so they go up and down. So that's not something I'm worried about. I'm a long-term oriented value investor, and so to me that creates an opportunity. In fact, that I think the stock has overreacted to that downturn. Now, it talks about the price to earnings ratio. I don't put a lot of stock into price to earnings ratios on midstream infrastructure companies. I look more at other things like EBITDA and distributable cash flow, and so we'll get into that in a minute. And so you can click on all these different things to learn more about it, various aspects of it, and I'm going to highlight the ones that matter the most to me here for this stock in particular. So here's one that I like a lot. It's the models, and these are quick valuation models. They've already done a lot of work for you. You can adjust it 5 to 10 years. I do 5 just because out to 10 years there's a lot more uncertainty, although with this type of business model, not quite as big of a deal. But let's just see what the valuations models are to see kind of a sense of fair value. Remember, this stock is trading in the mid to high $60 per share, depending on what day you're looking at it. So let's see. It's currently trading at $66.32. Based on their 5-year discounted cash flow model, it's estimated at $91.65. So you can see it's significantly undervalued there. All right, so what about some of these other models? We can go back. We can look at the EBITDA model. Based on that, it's also significantly undervalued, which you can see there. Finally, the revenue model, it's even more undervalued based on that model. So you can see, according to several models, it's quite undervalued. Another one I put a lot of stock in is enterprise value to EBITDA, because that accounts for the leverage. If a company's heavily levered and you just look at the equity component, sometimes, or the earnings component, that can make them appear cheaper than they really are, because if ONEOK were to be acquired by another company, its enterprise value is actually what would be determined what it would be sold for. So that includes the debt component of their capital stack. Meanwhile, EBITDA is a very popular metric in the midstream infrastructure space, because other companies, various companies will have different ways of calculating distributable cash flow or free cash flow or cash flow from operations or adjusted earnings. They have all these different metrics and they can all be massaged and manipulated. EBITDA is a pretty straight definition across the sector. And so again, an EBITDA is typically something that is looked at when determining whether to invest in a growth project or to make an acquisition. Is typically EBITDA is the metric that gets looked at. So this is a valuation multiple I put a lot of weight on. Here it's obviously a little bit less undervalued based on this metric than some of the other ones, but it's still significantly undervalued at 81.94 times. So we can see once again there that it looks quite undervalued. Now we can go over here and compare it. This is another one I really like to do. The financials are good. The earnings are good. The dividends are all good. The health is good. Those are all good things to look at as well. But it really depends, again, on the company you're looking at. And with ONEOK, from my view, it's got very stable cash flow, because over 90% of its cash flow is from contracted assets. And so when you combine that with the fact that it's retaining a lot of cash flow, paying down a lot of debt. This past quarter alone, it paid off about $500 million worth of senior notes. Year to date, it's paid down well over $1 billion. It's going to continue paying down debt. And so when you combine all those things, you can see that it has truly been it's very committed to paying down debt. It's got an investment grade credit rating. It's expecting to hit its target 3.5 times leverage ratio by the end of next year on a run rate basis, which is well below where their rating agencies want them to be. So I'm not worried about the balance sheet at all here. I really don't need to dig into those numbers. Again, the dividend, I've already talked about that. Their dividend payout ratio on a distributable cash flow basis is less than 50%. They're also buying back a lot of stock, which is further strengthening the dividend. So I'm really not worried about that story either. Here, I'm more worried about, is it truly undervalued relative to its peers? And so based on those models that I looked at on a cash flow basis, on an EBITDA basis, on a revenue basis, etc., it definitely looks undervalued. But let's look and see if that's just a sector-wide thing, because I do like the sector as a whole, or is OK just one of many, or is it particularly cheap and worth buying as opposed to just a broader index? Well, let's look at it. I think it's one of its nearest peers is Kinder Morgan, again, because that's a C corporation. Targa Resources, another one that's worth looking at, again, is a C corporation, whereas Plains All American Pipeline and Energy Transfer issue K1 tax forms. And so those often trade at a cheaper valuation because of the K1. It causes a lot of institutional investors to not invest in them. So when comparing ONEOK to peers, I like to compare it to fellow C corporations. So let's look at it compared to Kinder Morgan. Well, here you see that ONEOK has, based on, again, the investing pro fair value estimate, which is closer to the EBITDA estimate as opposed to the cash flow ones, it has 26.7% upside. Kinder Morgan only has 1.9% upside, and TRGP actually has 11% downside. So that makes ONEOK look very cheap compared to them. And in fact, it gets an undervalued score versus fair value and fair value for the others. And even with compared to Energy Transfer, it has a lot more upside. And Energy Transfer is rated fair versus ONEOK, which is undervalued. Now, Plains All American also looks quite undervalued, but again, it's a K1 issuer, so that needs to be kept in mind. Now, when we look at the fair value on analyst estimate, in terms of their consensus estimate for price target, this is another view of fair value. ONEOK has even more upside on that one, and we see that Energy Transfer is undervalued, Kinder Morgan is undervalued, Targa Resources is undervalued, and Plains All American is undervalued. But still, when looking at the upside percentage, ONEOK has the most percentage upside, once again indicating that it is arguably the most attractive of all of these, especially among the C corporations. When we look at their overall health score, Kinder Morgan only gets a fair scoring. All the others get good. So we see that ONEOK still stands out there. We're not taking on undue risk. Now, dividend yield is a place where ONEOK really stands out. Now, obviously, compared to its K1 issuing peers, it's lower, but that, again, that's a different story. Those ones are entirely different instruments. So it's a bit of apples and, or maybe oranges and tangerines comparison there, or an apple and a pear comparison. Whereas the true apples to apples would be ONEOK versus Kinder Morgan. And you can see it has 190 basis points of a higher yield and way more compared to Targa Resources, well more than twice. So ONEOK wins big time on the yield component. Now, when we look at the RSI, the Relative Strength Index, this tells us, is it potentially quite undervalued, especially on a market sentiment basis? And we can see here that, yes, it really is. Energy Transfers at 40.06, Kinder Morgan 35.51, Plains All American 45.87, TRGP 47.68, and ONEOK is way down at 27. So it is way more out of favor, way more opportunistic in my view, and that goes along with these other indicators that show that it is really truly quite cheap. Now here's another cool tool. Again, we've looked at a lot of these. Warren AI is something really unique that you can literally just, it's a chat bot that's powered by AI that's designed to be focused on investing and to tap into investing pros' unique data wealth of databases and knowledge. So it's almost like talking with ChatGPT, but it's talking with one that's tailor-made for investing. So it's really useful. So for example, I used it the other day. I want to find undervalued 5% plus yielding European infrastructure stocks. Give me a list of your top 10 picks that meet this description. So it did an automatic screen for me and gave me some comments about it. So here I did one on ONEOK. Summarize why OKE is the best C Corp midstream company to buy today. Also summarize the main risks to investing in OKE stock today. And this is just a good way to get some idea really quick if you just want to ask about different companies without doing all that analysis we just did. Well, here it does. It tells me, look, it's got a lot of upside to fair value, which we talked about. Now, its dividend yield doesn't seem quite accurate. So, again, this is just a quick overview. AI always can hallucinate, but it does tell me that it is a dividend yield story. So that's great. Now, obviously, before I buy it, I check what the dividend yield is anyway, but that just tells me the yield is pretty attractive. Again, the revenue growth, that it is doing a lot of growth, although, of course, this growth is exaggerated due to the fact they just did a bunch of acquisitions and they issued shares to do that. So that can be a bit misleading, but again, there's a growth story there, which is true. And it is an attractive value. It's trading near its 52-week low, which is very true. But it is also facing macro headwinds and recent analyst downgrades to its earnings, which I talked about, because there is a slight amount that is due to earnings headwinds. So there is risk there. So again, it gives me a nice chart showing the price versus the analyst price targets. Gives me, again, an emphasis, a summary of the bulls and the fact that they are unlocking synergies through their acquisitions. They're a highly profitable company. They're highly stable cash flows. And then again, the macro headwinds, the fact that they're trying to get their leverage ratio down, although it still is reasonable today, and that they need to execute on their synergy realization, which is a big risk. So again, it's a quick summary of the investment thesis. Don't take everything in here as gospel, as you never should with anything AI, because it can hallucinate or potentially take some things out of context, but it does give you a quick overview of the story to help you get brought up to speed and better target your study with these specific metrics. I want to go back to this page here, the overview page for ONEOK, and show you one other really cool feature that I found really useful, and that's news. Now, with this, you get, as a pro subscriber, you get access to these analyst reports. So for example, Scotiabank recently maintained ONEOK at sector outperform with a price target of $87. Goldman Sachs lowered it to 72 price target on macro concerns. ONEOK price target lowered to 72 at Goldman Sachs, same thing. Citi maintains their buy rating with a rating of $95. And again, you can see that this is recent. It's exclusive to pro subscribers. And you can click and read these articles and read the reasons why they believe what they believe. And it will tell you, give you more insight into why analysts are thinking what they're thinking. So it gives you more perspective, background on, again, the analyst consensus price targets and why they're thinking what they're thinking, making sure you're not overlooking anything. So finally, to conclude here, I also want to just do a final look at ONEOK a little bit more fundamentally to explain why I'm so bullish on it. And that really comes down to a couple factors. One, it has Very strong growth in this most recent quarter, sequential volume growth. There's growth across all of its different segments, and note how it's well diversified across natural gas, both liquids, gathering and processing, and pipelines, and also has a strong refined products and crude business that it acquired from its acquisition of Magellan Midstream Partners, which was a very high quality company when they bought it. You can see it's a nice located in middle America, which is competitively positioned and more resistant to some of the electrification trends that are more popular on the coastlines. So that should increase demand for their refined products and crude business. It's fully integrated. They have significant, as I said, a very stable business model with over 90% contracted assets across their different segments, and it's proven, battle tested through all sorts of oil price environments. They're unlocking a lot of synergies, almost $1.2 billion worth of synergies in total. They've already recognized the majority of those and have a good number on the way, or I should say they have the majority either currently recognized or likely in the near term they'll be realizing them, with an additional $200 million over the long term that they expect to do in addition. And again, they're well diversified across natural gas liquids, refined products and crude, natural gas gathering and processing, and natural gas pipelines. And again, these are all highly contracted businesses with 90% plus coming from that. They're making a lot of progress on their debt reduction. They are expecting to pay out a lot in dividends to grow at a steady pace that meets or beats inflation, while also buying back shares aggressively. They have a $2 billion share repurchase authorization, and they're targeting a large amount of cash flow returns to shareholders via dividends and buybacks. And so that all points to a very attractive outlook for the company, between the over 6% dividend yield, the expected growth of a consensus EPS CAGR of about 10%, and that's a proxy, what you could also say for their underlying distributable cash flow per share growth over the next several years. Their EBITDA should not be that much lower than that in terms of growth. Again, the stable defensive business model that's very well diversified, and they even have about 30 projects linked to data center demand from the AI boom that they may be doing with their natural gas pipelines that would likely drive additional attractive growth for them. So there's a lot to like here. Again, hopefully this was helpful for you in understanding how I look at stocks. Of course, I dig into the 10Ks. I do my own valuation multiple analysis. Maybe I'll do something like that in a future video. Of course, I pour over the earnings calls and look at all that. But the bottom line here is I think the risk reward is very attractive for OKE. And hopefully, again, this Investing Pro tool is useful for you. If you want to check it out, please check out the link in the pinned comment, as well as toward the top of the video description, and use my coupon code for an additional 15% discount on top of the limited time 55% Black Friday discount. Again, if you like this type of content, please give this video a like, aid in its distribution, subscribe for more in-depth deep dives like this. Thank you very much. See you next time.